All righty, what's going on, ladies and gentlemen and beautiful people? How is everybody doing today? Let's get this countdown out of the way because we are officially live. Guys, welcome back to the I Am Mastery Academy Bootcamp with your Go Live Master Educator, Manny Quinones. I'm very blessed and excited and grateful to be able to be here with each and every single one of you guys again. So in the meantime, if you guys can hear me and you guys are ready for today's class, simply type in where you guys are tuning in from right there in that chat box. Let's represent your city, your state, your town, your team, wherever you're from. Let's represent it. So that way we can definitely kick the day off right. And let's also share this stream with some of our newest members. So we are extremely excited to be here today. All righty. So before we begin, all right, there we go. Australia, Maryland, Barbados, Spartanburg, NYC, Hollywood, Florida, South Africa, North Carolina, Barbados, London, Norwood, Memphis. Man, what an incredible day. All right, so before we begin, let me start off with a quick introduction. My name is Manny Quinones. I'm one of the Go Live Master Educators. I'm also the Harmonic Scanner Master Educator, creator of the Triple Fire, Multi-Fire, and the Harmonic X strategy. Some simple strategies that any trader can learn how to utilize with the Harmonic Scanner right here in the market to start creating some consistent profits on a basis and get a solid foundation towards training. I'm also the voice behind the I Am Mastery Academy video series 100 and 200, which I hope you guys are thoroughly enjoying. Okay, remember, you guys can always come to my website right here, educatormannyq.com, if you guys want to connect with me or get a direct link right to our Go Live channel. And then we'll be updating the website with Go Live information, with event information, mentorship information, so on and so forth. And remember, anytime you have a new member, you can always click on New Member Training and get access to our Fast Start Sensor. Okay? But with that being said, what we're going to do, ladies and gentlemen, is we're going to kick off the very first I Am Mastery Academy Bootcamp course. So this is going to be I Am Mastery Academy Bootcamp Course 1 for all new members that's actually bringing about information for you guys. All right, so if you're watching this live or pre-recorded, please remember that this series is going to be a progressive 3 to 6 month series where we are going in depth through all the courses on the I Am Academy. So they're being taught right here on Go Live. All right, so with that being said, what we're going to do is we're going to start off this week with videos from the I Am Academy or from the I Am Sensor, and I'm going to show you guys right here on my screen. Alrighty, we initially went through what is Forex, participants of the market, so on and so forth. Today, we're going to get a little more in-depth on buy versus sell. What is a pip? What are lot sizes? What are pending orders? Right, and then what exactly is a spread? So that's exactly what we're going to be getting into today. So we want to make sure that you guys have the proper information that you need to succeed in the market before you get on with the technicals, before the psychology comes in. There are some very base components that you guys are going to need to know. So let's start off with one of the easiest ones for course 1, section 1. So course 1, section 1 is buy versus a sell. Now, if you're a brand new trader, then this is very, very textbook for you, as we do understand that the market simply moves in 2 directions. The market either moves up or the market either moves down. And that's all the market really does. The Forex market to us, when you're trading after a while, starts to feel like a game of cat and mouse. You know, when price increases, we have an opportunity to buy to make money, and then eventually price will decrease. And when price decreases, we have the opportunity to sell and make money. And the market will continue this cycle of moving up and moving down and moving down and moving up and moving up and moving down and moving down and moving up and moving up and moving down. The market will always continue this, as it's shown throughout history. Even when the market consolidates, which means that the market is going sideways, eventually it's going to make a drastic move up or it's going to make a drastic move down. So the whole purpose about being a trader is simply knowing when the market is going to make that move. And when the market is ready to make that move, you have to be prepared for it. That's why throughout this entire Academy course and throughout the Go Live Master Academy course, right, we're going to be teaching you very, very simple concepts so that way you can understand how to catch the market, how to analyze the market, to predict and forecast the next move and say, hey, will the market continue to break and move up? Should I buy? Or it's going to break and come down, and should I sell? As you progress throughout your trading journey, you're going to become a master at this. And the more you master this information, the more you will master your profits, the more that you will take more control over your life. So the difference between a buy and sell is that when you're buying, the value of one currency is increasing And when you're selling, the value of the other currency is decreasing. And all this is a representation of price. Every single point, wherever the market is at, is directly tied and correlated to a price. And the price that you see on the side of your screen right here is the current exchange value for the particular currency that you're trading. Okay, so whether you're trading Euro USD, GBP USD, if you're trading gold, commodities, different things like that, this is exactly what you're going to see right over here on the right side. Okay, so with that being said, I believe that buying versus selling is very, very textbook. So with that being said, let's move into some more solid information. Okay, so let's copy this, remove everything on our screen. Perfect, and then bring this back. All righty. So now we're going to talk about what is a pip, ladies and gentlemen. Okay, what exactly is a pip? I want to teach you guys how to calculate pips for three very important type of markets: the base currency market, the Japanese market, and then also the gold market. Okay, it's very, very important that whenever you are trading, you understand how to calculate pips, because the pips is basically the money within the market. You may hear many, many, many traders say, I'm catching pips. How many pips did you catch? You'll see that all over social media. You'll see your trader friends saying that. How many pips that you caught is sort of like a trophy to many traders. They're always looking for a trade opportunity, and then they're looking for how many pips they can secure on a specific trade opportunity. Meaning, let's say, as an example, a trader were to look at this specific market over here. And then the trader said, okay, well, the market, let's say, for instance, broke this trend line and retested, and now we are selling at this retest right over here. Okay, they say that we're selling at that retest. Well, from this retest, from this specific price point, which is 1, we'll write that down to here. So let's write that down. This specific price point right here is 1.11950, right? We're going to make that larger. That is this specific price point right here within the market, right here at this line. That is this specific price where the trader is looking to sell. Now, from this current point in the market, following to where the market is at right now currently, it's currently at 1.11604. So let's put 1.11604 right over here. So we sold the currency, okay? Let's put this right here. We sold the currency at 1.11950. And the current market value of the currency is 1.11, okay, 604, okay? So the gap in between these numbers is what represents the pip counts. That pip count, as we progress to what is lot sizes, this pip count is going to help you determine how much money you potentially made or how much money you potentially lost within the market, depending on the lot size that you trade. So you have to be very mindful of the pip count of the said currency, because this is going to allow you to say, okay, what do I want to trade? How big of a lot size do I want to trade? If my take profit is going to be 35 pips, how much money am I going to make on 35 pips? Or let's say you was looking to buy and you wanted at this point to the market to go up, but the market came down, and then you set a stop loss at 35 pips. You have to understand how many pips the market's going to move, so you know what lot size you want to trade. So that way you understand how much money you're risking for how much money you could potentially make. People do not like to call trading gambling, but if you want to have the mindsets of gambling, think about it like that. How much money am I willing to lose to make? I'm willing to make 100. I want to make 100 and I'm willing to lose 20. I want to make 100 and I'm willing to lose 20. If you're okay with that, you set your entry, your stop loss, your take profit, and you go in for the trade. So let's get back to pips. Now, whenever you're looking at this, let's take a look, okay? When you see this decimal on pretty much any single currency, except for the Japanese yens, which we're going to get to. So this is how majority of the currencies look. So let's take a look at that. Any two digits before and after the decimal right over here. Okay, let's change this to like a light blue. There we go. I'm going to calculate it right now. any two, when you're looking at the currency, when you're looking at your phone, and you need to understand the pip size, the pip count. Yes, the first two digits before the decimal and the two digits after the decimal. This is known. This is the base right here. This is the base exchange rates. EXCHANG. Sorry, because I can't type, talk, and think. Right. This is known as the base exchange rate. This means the euro to the US dollar is $1.11. So for every $1.11 in euro is equivalent to $1 US in the US. So the euro is technically worth 11 more cents than the US dollar right now if you want to go exchange it. Okay? That is exactly the base currency rate. Now, the two following digits right here, following this in the third and fourth decimal place, right over here, this is known as the pips. The pip stands for points in percentage. Okay, it stands for point in percentage. So every time the pip moves one, kind of like a clock, every time it moves one, every time it ticks one. So let's make this example. It goes from 11950 to 11960. So then 11970, right? 970 right here. My goodness. There we go. Forgive me, guys, for these little technical difficulties that we have here. Okay, to 11970. There we go. All righty. Right over here. Now, every time, just follow that red number. Every time this number increases, the pip size or the pip count goes up or down by one. So if it starts at 9.5 and it goes to 9.6, that's one pip. If it goes to 9.7, that's 2 pips. If it goes to 9.8, that's 3 pips. If it goes to 9.9, that's 4 pips. And then the numbers roll over. When these digits get to 10, the number carries over, and then this decimal changes. So 1, 2, 3, 4, 5, 6, 7, 8, 9. When this decimal changes, and this goes all the way up, then that's when the actual exchange rate changes to $1.12. So all of these little point in percentage, all of these little points here is what traders like you and I are making significant money off of in the market. Yet they're not very noticeable on a day-to-day scale when you're exchanging, your dollar, your said currency around the world. But this is the pip count. Okay, so as this increases or decreases in this case, because the exchange rate is coming down, as it decreases, okay, this is still the pip count, but coming down if you're selling. So good thing we have pip calculators and we have tools. So if you come to the measurement bar, like let's say you're using TradingView or any platform that you're using, whenever you use the toolbar, you can simply come from where you want to calculate and move the measurement bar to wherever you're looking to go. And by doing that, it'll automatically give you the pip count. So it makes it a lot easier for you to set up your take profits and your stop losses. Okay, but when you're doing it on the phone, you also want to see. Now, a good way to always calculate these pips is to bring up the calculator. You could always do something like 1.1195, and then you can minus 1.11604. The remaining right there will tell you how many pips that was. And you see that was a 34 pip move. Okay? So calculating the pips, can you explain the numbers in the measurement bar? So the measurement bar simply finds the starting point and finds the end point. Now, this right here, what you're looking at, these initial numbers that you're going to see right over here, this is the actual pip count. This is the actual percentage, the pips that are moving in the market. So from this point to this point, you see the decimal, the third and the fourth decimal. The third and the fourth decimal here came down 32 points. So that 32 points is a 0.29% decrease in price, right? The 30 bars, meaning if you take, let's say, this specific candlestick to this specific candlestick, this is basically telling you it moved 0.33, in this example, 0.33 pips is a 0.30% decrease from here to here. It took 13 bars on this time frame, which is the 1 hour. So it took 13 hours for this market to drop off 33 pips. And they make the numbers for you nice and easy right here to the right, 33.4 pips. Okay? So that gives it to you there. That's how we calculate the pips. Now, when you come over to the yen, right? Let's try USD JPY. USD JPY, you calculate it a little bit different, right? So let's come here. Let's remove all drawing tools. Now, when you look at any yens, you'll see the current base for the yen is 108,450, right? 108,450, right? So look, this is how you calculate the pips for the yen. Look at the decimal. Instead of moving over 4, the pip count is the second decimal in right over here. Okay, so let's take a look. So that means that every time the market goes from 108.45 to 108, right, 0.46, the market moved 1 pip. Or if the market went to 108.44, okay, whether moving up or down, the pip count for the yen is the second decimal place. That is 1 pip. If it's 10 pips, then it's right here. So 44, 45, 46. This is how you calculate the pips for the yen. All right. So as you see, it's the first, it's basically the second, while in the basic exchange rate, it's the fourth for any other currency. Now, with the exception of gold, let's go to XAU USD. Many people like to trade gold and they don't understand how to trade gold within the market. Okay, so if we come over here and we look at gold, let's look at gold. 150 or 115.67.595. That is the current exchange rate of gold at this particular point. 195.67.595. Let's just do 600 to make it nice and easy. Okay, 600, nice and easy. Now I'm going to put gold on the 1 minute because gold moves so volatile. This is why people really, really love gold. So if you take gold and you use the measurement bar and you're coming here, so let's say gold is coming down. Oh, let me put less. From 60 right over here. Okay. Now, if you look, you'll see that the pip count starts at the first digit immediately following the decimal. Let me try to make it even smaller. Okay. So let's take a look right over here. Okay, so if it starts here, the pip count goes to 1567.610. 1567.620. Okay, these digits right here is where the pip count starts in gold, right over here. But now because gold moves so rapidly, when it moves 10 pips, it'll take up the first 2 in the market, just like the yen. Right over here. So these first 2 decimals, basically right after gold, is what the pip count is. And you see how volatile gold moves. If we start here, from here to here, look at how fast the gold is actually moving within the market. Okay, almost 38 points. But it's calculated different in your MT4. So that's why you want to be very careful when trading gold and using lower lot size, because it multiplies by 10 almost within your MT4. Okay, something that we're going to be covering very, very soon. But it's important to understand where the actual pip count comes into place when it comes to gold, the yen, and other specific currencies. All righty, ladies and gentlemen. All right. Now, all right, now next, let's move over. Since we went through what are pips, you guys understand what are pips. Now let's talk about quickly what are lot sizes. All righty, let's talk about what are lot sizes. Now, lot sizes are used basically as, I'm going to give you guys like a mathematical formula because many people get confused on what lot size that they should use for their accounts. Okay, so what exactly are lot sizes? Whenever you're trading, you're going to notice that you can trade basic positions known as micro, mini, and standard, right? And there's all variations in between this. So I'm going to break down this specific lot size for you, which is very simple. And then we're going to get into different variations of this. I'm going to give you guys a small mathematical formula to help you guys understand, how to calculate what you're willing to risk in the market. So as we all know, the micro is the smallest lot size you can trade, right? It's a 0.01, right? It looks like the equivalence of 1 penny, right? It looks like the equivalent of 1 penny. So you might hear people say, oh, you're trading a penny, you're trading 10 cents, you're trading $1. That is technically incorrect. what you're trading is units of measurement within the forex market. So every time you leverage a penny, you're basically using 10 standard units of that. You're trading 10 standard units of that currency. Everything in the forex market is multiplied by 10. Okay? So just remember this. Whatever you're trading, you increase that by 10. Okay? And then that's going to tell you how much money you're going to make per lot size. So as an example, if you're trading a 0.01, that's going to equal 10 cents, right? That's going to equal 10 cents per point that the market moves, okay? Just by trading a 0.01. This is the smallest position that you can trade, okay? Smallest position that you could trade. You can make 10 cents per point within the market, trading 0.01s. Now, if we move to mini is the next quote-unquote standard type of position that you could trade. This is where it looks like you're trading what's known as 10 cents, quote unquote, the mini. It looks like a 10-cent position. However, at this point, you're actually trading 100 units of a base currency. Okay? So remember, just multiply your lot size by 10, and that's going to tell you how much money you're going to make per point. So if you have 10 cents, it's just very simple mathematics. If you have 10 cents, if you have a dime, and then you times the dime by 10, how much money is that? 1 US dime is 10 cents. If you have 10 US dimes, that's $1. That's the same way to look at the market, right? So if you're trading a mini 0.10, guys, that is going to make you $1 US per point that the market moves. Okay? And then the last quote unquote official standard position is what's known as the standard. That's where you're trading what looks like a dollar size to the human eye. It just looks like you're trading a dollar. That's what you're putting in your MT4. It says 1.00, clearly looks like a dollar, but you're trading a lot more, right? So remember, just multiply this by 10. So if you have a dollar and I say, hey, I'm going to times that dollar by $10, then what's going to end up happening? You're going to end up having $10. So this is going to be 10 USD per point in the market. All right, ladies and gentlemen, 10 US dollars per point. Now, when you have the mini, the micro, and the standard, these are the base units, but there's all type of variations. As an example, if you decide to trade a 0.25, right? I want to start giving you guys the formula, right? FORMU, right? So I like to call this the it was just the formula, right? So just put it as the money making formula, right? The FRX money making formula. Okay, so this is where people, when they're looking at their MT4, they get confused about, especially if you're a new trader and you're saying, okay, well, if I trade this, the market moved these many points, how much money am I losing? How much money am I going to make? You don't know. You're kind of just winging it. We don't want you to wing it. We want you to know trading is becoming your profession. So you have to know exactly what's moving around in the market, right? You're not going to go and just gamble your whole bank account away, right? You're not going to say, here, take my debit card. I don't know what I'm going to trade, but I'm going to do it all until I'm broke. You're not going to do that. So the FRX money-making formula is very simple. You take, right? So you take your lot size, right? Times that by 10, right? So you're going to take your lot size times 10, right? Times your pip count, right? And then that's going to equal the total amount of win or loss, okay? Win or loss. That is going to be the whole formula for you. So let me give you an example. So let's say for this lot size example, you want to trade a 0.25. Okay, the 0.25 is your lot size, right? The 0.25 is your lot size. Well, you have to take that lot size and times it by 10, right, to know how much money you're going to make per point. So 0.2, I know how to do it, but I'm just going to show you. 0.25 times 10 right over here means that you're going to make $2.50 per point that the market moves. Right, you're going to make $2.50 per point the market moves. Now, you're going to times that, again, by your pip count. So your lot size, which is right over here. Okay, so it's lot size. All right, it's your lot size times 10, right? Times your pip count, and that's going to equal your money. So let's say the market is going to move, you're looking at the market moving 30 points. Market just moved 30 pips, right? So now you're saying, okay, well, how much money am I going to, if my stop loss is 30 points, how much money am I going to lose? Well, you take 250, Look, you take 2, let's clear that. You take 2.50 times that by 30, and boom, $75. So if your stop loss is 30 points, then you're going to lose. Then you can potentially lose $75. If your take profit is, let's say, 50 points, right? Let's say your take profit is 50 points. You take 2.50 times 50. Let's say that's your take profit, 125. So you're willing to risk, let's say in this example, you're willing to risk $75 to make, right? So you're willing to risk 75 for $125. Okay? This is basically the formula. This allows you to know how much money you're going to potentially lose or make on any given trade. All right, ladies and gentlemen, if that makes sense to you, just please type a 111 in the chat box, especially if you are brand new. Pardon me, type an 888 in the chat box if that did make sense to you here. Okay? Remember, you take the lot size, times it by 10, so you know how much money you're making per point, and then you times that amount by your all the points that you want to make, and that will tell you the exact dollar amounts that you're going to win or lose. Okay? And I got the calculator on my screen on an Apple. If you guys have a Mac computer, you just go there. There's like this little button icon all the way to the top right. And then this is your whole like notification type of menu that comes with your Apple computer. All Apples have it, right? And then your calculator is right here. Or you could simply do it on your phone with the PIP calculator. All right, ladies and gentlemen. So that's that. Now, we covered buy versus sell. What is a PIP? What is lot sizes? Now we're going to move over to what exactly are pending orders within the market and how to use them. I believe that this is a very, very, very important understanding to the market. So I'm not going to just tell you what pending orders are. I'm also going to show you guys some of the best times or how to use pending orders. Like, what is the purpose of a pending order? When you start out and you're very new in the market, you're just doing a lot of market execution. You might get it's like every trader before you has always done this. I've done this. Everybody's done that. Somebody will say, put a sell stop, and then you end up putting sell by market by accident, right? Because you don't understand the pending orders. So let's talk about the 5 type of pending orders quickly, okay? Pending order 1 is known as market execution, right? Pending order number 1, let's increase that to 20. Pending order number 1 is market execution. Market execution means buy or sell right now. So let's say this point of the market right here. Let's say this point in the market right here. And then you want the market to keep going down. You can choose to just jump into the market right now, cold feet, sell, boom, market drops. You're looking to make money. You know, you're excited. Market execution is buying or selling right now on the spot. Once you're in, you're in. You're live. That's it. Boom. Now, a trader, as you guys grow throughout your trading journey, right? So setting a loss means money you lose only if that goes in that direction. What if you don't set a stop loss? Exactly. So if you buy, pardon me, I must not explain that. If this is the current market that you're looking at and you're looking to buy, you will only make money if the market goes up. If you're buying and the market goes down, you lose money. Now, if you're selling and you want the market to go down, but the market goes up, then you lose money. So if you're buying or selling, the market has to go in that direction. If it does not go in that direction, then you're losing money. So if you sell and it goes down, you make money. If you buy and go up, you make money. But if you buy and the market goes down, you lose. If you sell and the market goes up, you lose. So that's why you have to know the difference between buying and selling. You have to make sure the market goes in your direction. Okay, Money Magnet 18. Now, getting back to the pending orders, okay? 5 pending orders. Market execution is when you're jumping into the market right now. Now, as you develop throughout your trading career, what's going to happen is that you're going to start to catch FOMO. FOMO is what's known as the fear of missing out. You're going to start looking at a market and you're going to see the market going in a certain direction, and you're not going to want to miss out on that opportunity to make money. So you just jump right into the market. But as a seasoned trader, what you want to do is you want to wait for the right point in the market. You can come to your trading view. You can set price alerts in trading view. You can get notifications to your phone, to your emails. When you're waiting for the market, remember, it's a game of cat and mouse. You always want to wait for certain sell models, certain buy models, certain price zones to hit, right, in order for you to execute a specific trade. And the same is true whether you're trading currencies, if you're trading crypto, or even if you're trading high frequency Forex, which is known as binary. You have to wait for the market to get to a certain point to move. Okay? So market execution is where you're just getting into the market. Now, we also have other type of orders, which is known as buy limit, okay, and buy stop. So let's talk about buy limit and buy stop quickly right over here. Okay, buy limit and buy stop. I think I put a background on here. Let me see. There we go. No background cover. All right. So now you have a buy limit and buy stop. So let's talk about, let's look at this market right here, right now. Okay, let's talk about this. I'm going to move this over so we can get this nice and clean. Over here, let's lighten this up so we can make sense of this. Okay, I'm going to give you guys real examples of this, right? Okay, all right. Now, let's say you are looking, so the market is right here, and you want to wait for the market to come right down here, right? Let's say you're waiting for the market to come and touch that low point. So as a trader, you're saying to yourself, you're saying, hey, I'm expecting the market to come right back to this low point. When the market touches this price level of, let's say, 1.11300, right? So let's set that level, 1.11300, okay? You did a nice analysis. You're looking at the market. You might have thrown some Fibonacci's. You did whatever you had to do, right? And then you're saying, okay, the market, when the market comes back to this price area, 1.11300, I am expecting the market to bounce back up. I'm expecting that buy right over here. Now, traders do different type of things. They'll either wait till the market comes, let's say right down here. Let me give you an example. They'll wait till, let's say, the market comes right down here, and then they'll wait for a setup, and they'll say, okay, they'll wait for some type of reversal pattern. And when the reversal pattern happens, they're going to buy market. Boom. And then they buy after the market gave them clues. But now another trader will say, hey, you know what? I'm simply expecting this market to come to this level and then just disappear. I cannot wait for this. I'm going about my day. I have to go to work. I have to see my kids. I'm not looking at my phone. But you know what? I don't want to miss this opportunity. And I believe that when the market comes here, even if the market consolidates for a little bit, I believe that the overall direction of this trade is going to go up. So this is where traders put in buy limits, right? They're not too worried. Even if it goes left and right, they're more concerned about making sure that they're able to trigger that buy at that price that they want, because they feel that that's a good price. So by putting a buy limit, what happens is that as the market comes down, the moment that the market touches that price level of 1.11300, the minute the candle, the wick, the minute it touches that, what ends up happening is that the broker automatically activates your trade. It automatically activates your trade and puts you in a buy position. And if the market from this point continues to go up, you get to make money. So the minute it touches that, whether you're looking or not, it activates your buy position. The minute it comes to that price point, it activates the buy position, and boom, you're in the trade. Okay, you didn't manually do it. You did it through the buy limit. Alrighty, so that's how the buy limit works. Now, let's say you want to do what's known as a buy stop. Okay, a buy stop means that you're going to wait. So let's come over here. So let's say you put in right over here, right? Let's just make this little example. I'm going to make it as best as I can. Let's say you waited. Let's say some traders came in, they put a buy limit at 1.11300. It whipped that price point. It activated the buy limit. Now they're in the trade. Now, other traders, let's say another trader is looking at the market, and then they see this specific point right over here, right? They see this specific swing high, right? What another trader is going to do is the trader is going to now want to put what's known as a buy stop. So a buy stop, I like to use buy stops basically. Think about it like a bus stop, right? Let me actually create the example for a buy limit. So a buy limit is when the market is coming down, it hits the entry, it hits the price point, and then it activates the trade. And if the market goes up, you make money. Let's put that blue. But if the market goes down, you lose money. And then we'll make that red for visual purposes. Okay? That's a buy limit. Now, a buy stop, I like to look at a buy stop sort of like a bus stop, right? A bus stop works like this. The bus is coming. It makes a pit stop real quick to pick you up right there, right? And then the bus keeps on driving, right? That's what a bus does. A bus drives to you, it stops, it picks you up, and then it keeps on going. The buy stop works the same way in the market. Traders like to put in buy stops because once something happens in the market, they say, okay, the market's starting to come up, and if the market passes this specific price point, let's say 111,500, that's going to be your bus stop, right? 1.11500. That's your bus stop number right over there. So you're saying to yourself, you're going to say, well, if price comes here, makes a reversal, and then keeps going up, and it keeps going up, and it passes this price point, I just know once it breaks that high, I know once it breaks this number, I know the market's going to keep going up. So you know what? I got to go to sleep. I got to go to work. I cannot wait for this. I'm just going to set my buy stop, and that's what's going to happen. The price is going to come up. The minute it hits that price point, that's your bus stop. It's going to pick up your order, activate your trade, and then you're expecting the market to keep on going. And if it goes up, you're in profit. But if it picks up your order and goes down, you lose money. Okay? Yeah, I mean, not permanently, but I mean, you're in drawdown, right? You're in drawdown, right? So as long as it stays above that price level, you're making money. If it goes below the price level, you are losing money. Okay, so that's a buy stop. Now, look, as this example right over here, remember we just talked about this example? What traders will do, let's say the trader is looking back at this level. This would have been a great example right over here to put a sell limit. Let's say the trader looked at this specific point, right? They looked at this specific point, and then the trader said to themselves, hey, look, the market broke the trend. I know the market wants to retest the trend. The retesting of the trend, the outside of the trend is up here. The outside of the trend is also the 618 fib level. The 618 fib level is coming back to that high, right? So for my teacup traders, shout out to you. You guys are saying, hey, well, look, the minute that price comes right back over here, I know the price is about to teacup, right? That's why all teacups are sell limit orders. So you see the teacup, you see the candle, you see the fib level. The market is not yet there, right? Let's do a replay. The market is not yet there. So this is what it looks like. And then you set a sell limit right over here. Boom, you got your sell limit right here. Now, if you look at this trade and then you just go through, look, guys, boom. Almost hit it. Bingo. So right there, right? If you zoom in, you can see that was your sell limit. It just hit that price point, activated your sell limit. Now, what's happening? Right now, the market's going up. So now you're in a drawdown. Boom. Now you're back at break even. Boom. You're still back at break even. Next candle goes below the entry of your sell limit. Now you're in profit, right? Anything below, let's come over here, right? Anything below your sell limit is your profit, and anything above your sell limit is your drawdown. Okay? And that's your drawdown. All righty, ladies and gentlemen. So now buy stops and sell stops work the same exact way. So let's, boom. So buy limits and buy stops work the same exact way for sell limits and sell stops. It's literally no different, just on the opposite side. So a sell limit, once again, is when you're expecting price to come to a point, pick up that order and drop, okay? And then a sell stop is just like the bus stop, but you're expecting the market to keep going down. So as an example, let's say you're looking at this low in the market, and you're gonna say to yourself, okay, well, once the market, let's exit the replay, let's look at the live market, okay? See how the market's coming down? And then you're gonna say to yourself, hey, if the market breaks this low right over here, and then I'm going to put a sell stop right down here, right? I'm going to put a sell stop right down here at 111,200. No, let's do 111,100. And you're going to say to yourself, well, look, the market is about to, if it breaks this low, it's going to have to break the low, retest, and then keep going down. So I'm going to put my sell stop right over here, just like a bus stop. Once it hits this order, it's going to pick up your order. And if it keeps going, you are in profit, right? Look at an example here. Let's say the market is coming up. You were expecting that high to get broken. If that high got broken and you put a buy stop right above there and the market kept going, you would have been in profits. So those are the pending orders. Market execution, buy limit, buy stop, sell limit, sell stop. These are the 5 type of market execution orders, right? Well, we're not talking about take profits and stop losses yet. Remember, we're following the IM Academy. So as we get to those videos, we will be more in depth, right? So These are the pending orders. If you guys know all 5 pending orders, just type a 5 in that chat box, and then let me know that this makes sense, right? Let me know that makes sense by typing a 5 in the chat box, so I know that you guys understand what pending orders are and how to use them. Remember, if you're brand new, it's good that you're taking in this information because it's going to serve a purpose later down the line, ladies and gentlemen. And now we're going to wrap up the class with what's known as spreads. So the spread is very, very, very simple to explain, okay? The spread is basically the bid versus the ask price, okay? It's the bid versus the ask price. So it means where you're getting in, right? Where you're getting in, the ask and then the bid, and then where the market is going to put you in the trade, okay? So let's say you want to buy, right? Let's say you want to buy. So if you want to buy, right, we're going to make this very realistic. Let's say you want to buy right here at 1.10970. So let's say you want to put a buy by market at 1.10970. You see the market right here, right? And then you want to put in a buy at this price. You see the market's breaking the high, right? Let me actually go down to the 15 minute. Or let's go down to the 5, right? Let's come over here. Let's make this real. All right, perfect. So let's take a look, right? So here goes the high point in the market at 1.7. Now you want to buy right here. You see that the market broke that high and retested that high. And then you wanted to get in right over here at the breakout and the retest. That's exactly where you wanted to get in for that buy for the market to go up, right? So that's your ask. Now, the bid, what they're going to do, or the spread, what's going to happen is that the market is going to put you in above. So the market will, let's say, give you a 3-pip spread, right? And then you'll see it. You'll get a 3-pip spread. So the 3-pip spread, the market is going to put you in at 1.1000, right? That's 3 pips. If you remember, if you put 97, 98, 99, 900, this goes to a 0. The decimal carries over. So this is where the exchange rate changes, right? Right over here, okay? So boom. So what ends up happening is that you want to get in the market at 1.10970, but the market is going to put you in at 1.1100. They're going to give you a 3-pip spread. And that 3-pip spread is going to be the gap from where you're starting to where the broker is going to actually put you in. And you have to make up that spread. You have to make up that spread. That spread belongs to the broker. The spread belongs to the broker. This is why every single time that you guys get into a trade, it always starts off as red. You're like, man, how come every time I get into a trade, it's always red, it's always red, it's always red? It's red because the minute that they put you into the trade, you're already down your 3 pips. You have to make up the spread. You have to make up the spread to break even. And then anything above the spread is now considered your profits. Okay? Price range. Anything above the spread is now considered your profits. Anything between your spread and your entry, right over here, that's the gray area that belongs to your broker. And anything below the spread, price range, and anything below the spread is money that you are losing. That's money that you're in a drawdown, okay? So the broker makes it very, very easy for them to make money and very, very easy for you to lose money. Because if you're breaking even or the market's going up 3 pips and you back out, the broker's still making money off the commission of the trade. They're making money on the spread of the trade, the whole entire 9. All right. Oh, there we go. So now people are understanding. Perfect. So that's exactly what the spread is. So it's very important. Now, what I want to say is that anytime you're looking at your MT4, okay, anytime that you're looking at your MT4, please be mindful of the spreads. Now, when are spreads high? Okay, when are spreads high? And this is going to be the final tip that I'm going to give you. We're going to wrap up the IM Mastery Academy Bootcamp Course 1. Spreads are the highest when market opens. Okay, so whenever the market opens on a Sunday, you'll notice that the spreads are humongous. They're humongous. You never want to trade a high spread. When news occurs, okay, spread can be the spreads can be very, very high when the news occurs, right? Because they know that a lot of people are about to get into the market. right? So these are 2 times when the spreads are the highest in the market. Ladies and gentlemen, please don't ever, ever, ever get into a trade if the spread is more than 5 pips. Don't enter the trade, okay? I personally never, ever, ever enter the trade, if the spread is more than 5 pips. That's why everybody's always looking for good brokers to have, so that way they can get good spreads, right? That's why I use Hugo's way, because if the spread is high, what can end up happening is that you're going to learn this on another class, but then there's something that's known as a swap. And what happens is that if you get in and then the spread is 5 pips and the market becomes very volatile, the broker ends up changing the spread to 15. And then when the spread gets changed to 15, you could be 15 pips in profit, but you could be making $0 on the trade because of the spread. Okay? So you always want to trade when spreads are low to protect your money. Okay, the higher the spread, the more that the market is really manipulating that said currency pair. So if the spread is low, it's a lot safer to get into the market. All right, ladies and gentlemen, please always be mindful to that. But anyway, ladies and gentlemen, look. With that being said, why does it say that I'm not live? Okay. With that being said, all right, guys, am I still live? Am I here? If I am live, just type I am. If you guys can still hear me, because for some reason this thing is telling me that I am not live. All right. And I hope that this broadcast is not getting interrupted. All righty. So anyway, ladies and gentlemen, this is going to conclude our I Am Mastery Academy Bootcamp Course 1. All right. I hope that you guys found today's information very, very, very insightful. I hope you guys learned a ton of details within the market, ladies and gentlemen. Okay, let's come right back over here. Okay, I hope you guys found okay, I'm definitely not live. I don't know what happened, but my broadcast cut off. All righty. Well, for those that are watching the recording, I hope that you guys found today's information extremely, extremely valuable. Okay, there we go. We're back live. I must have just had a broadcast interruption. So I hope you guys found this information extremely, extremely valuable. Ladies and gentlemen, please remember to continue to have your members log in to our class right here for the entire I Am Mastery Academy Bootcamp, ladies and gentlemen. Okay, all of these recordings are going to be accessible every single day. Simply come back to our channel right over here and click on favorite sessions. By clicking on favorite sessions, you'll have access to our multi-fire strategy masterclass, our harmonic X masterclass, our market geometry training, and then all of the I Am Academy Bootcamp video courses are going to be right here as well under favorites on my channel. So not only can you rewatch this replay, but when you sign and you register new members and you want to give them a solid foundation, they can come right here after watching the academy, or they can simply just come here and get the entire academy in depth. All right, we want to make sure that we give everybody a firm understanding in the market. All right, ladies and gentlemen, please remember that